Good morning, Jags. This is Fahad. Today is Monday, October 5th. Just a reminder to everybody that the fourth quarter outlook is complete and it has been published. It's available to purchase for $125 right on the website. And I gave you guys the preview in Telegram yesterday as to what's in it and what to expect and what was our thinking as we made those picks. Two of those stocks, by the way, already have the positive commentary from analysts this morning, so they'll be moving nicely. So with that said, let's move on. GAN Limited, two stocks I want to cover real quick. The first one is GAN Limited. As I shared in Telegram not too long ago, GAN Limited is spiking sharply higher by more than 12-13% in pre-market now. It's at pre-market high, and I think it's going to run even more from this level. At a minimum, I'm expecting a run back towards $20 per share, which is going to be a major hurdle, major VOP congestion level. So the stock is at 18.50 in pre-market. We'll see if this thing will be able to rip through all of this congestion around 20. And if it does, then there is a lot of air pocket above that all the way back to $25 per share. So there could be a lot of move coming given how depressed the momentum indicators are and how depressed the stock is right now. The news is really this, as you all saw in the first read as well. GAN Limited has signed a 10-year software platform agreement with Wynn Resorts to expand its coverage into Michigan. This is all happening in planning stages because, as you know, the state of Michigan is expected to legalize the sports betting as well as iGaming technologies sometime, hopefully by Thanksgiving. The law was already passed over here almost a year ago in December 2019, but the formalities that has to do with the inner workings of signing contracts with casinos and such, that's been what's holding it back, but it's supposed to be all done by Thanksgiving, and it should be coming pretty soon. Naturally, that's going to be positive again, limited with this partnership coming in with Wynn Resorts, as well as it will also be positive for DraftKings and the other company, Penn National Gaming, PENN. So expect continued momentum in GAN Limited from this news. Now, with that said, I do have one stock that I want to cover real quick. And that stock is our Charter Communications, symbol CHTR. This is a broadband provider or cable network provider in your homes. As you know, one of the largest in the country. The stock has been steadily rising for the last several months. It's been very strong, firm uptrend. And I bring this up because a couple of weeks ago, if you go to the activity tracker, you will see that we pointed out in the chat room, there was a large buyer of 7,500 of the June 2021 760 920 call spread for $15.85. So do the math. 7,500 multiplied by 100 multiplied by 1585. This was nearly $12 million bullish bet. A single trade went off. Large institution. That's 7,500 of June 2021 760 920 call spread for 1585. And think about this, because that's about 9 months out, right? And so this is June 2021, this is October right now, and the stock is trading at 620, and they were buying 760. The stock is at 620, they were buying 760, 920 call spread out in June. So the question becomes really what's happening over here. So I'm going to give you a quick color on a bunch of things that you need to keep in mind. First of all, note that this company has been benefiting sharply with the work from home crowd because everybody needs broadband in order to work from home. But not only that, students and teachers are also working from home. Many of the online classes are taking place at home. And so what we have learned from this environment is basically how much the digital divide was that we were not aware of. There is this article that was published in this journal called commonsensemedia.com, which is a private organization, and that reflects on a bunch of things. The digital divide has been such a big problem for decades that the pandemic revealed its scale. A new study by Common Sense Media estimates that the country's 51 million students, up to 15 million, either had no home broadband service or lack service that can handle the demands of online classes, such as hours of video conferences per day. What's more, up to 400,000 teachers also lack adequate connections. Cell phone service didn't count in this measure due to data caps, limited broadband, and the difficulty of working on tiny screens. So I didn't realize this, but up to 51 million students um, basically lack the proper internet connection at home. That's what the pandemic revealed. 15 million have absolutely no home broadband service at all, and 400,000 teachers lack the adequate connections as well. You know, talk about the teleconferences such as Zoom video and how much bandwidth it uses and such and such. This was announced, this was revealed by this nonprofit organization, and in order to tackle that, going back to my screen, the company launched in June of a couple months ago a service called a service called REO, I think it was called it. I have to completely check over here, but basically, this service was announced specifically to target the students that are working from home by giving them a specific low-cost broadband connection at home. But then the service was only launched for about 60 days, but then it was discontinued and for some reason. But then they relaunched this very recently, only about 15 days ago on September 20th. And if you look at the last earnings report, it's called Remote Education Offer, or REO, Remote Education Offer. So they relaunched this on September 21st. As you can see, this is the press release, with another 60-day Spectrum internet and Wi-Fi offer to help connect new households with K-12 and college students for educators, up to 200 megabytes per second, and all of this. Now, the reason why I bring this up is because as a result of this, the forward earnings estimates are now starting to move higher. So here is a comment that came out from Bank of America this morning, in which they say that we are adjusting a residential net add forecast to 400,000 versus previous forecast of 325,000, and we are lowering our video net loss forecast to a negative 100,000 from what was expected to be a negative 125,000 on the halo effect of better broadband. We're also raising our small to medium business forecast given better trends in that marketplace and positive management commentary. And if you look at all of these metrics for fiscal year 2020, cable revenue growth is now seen to be 4% year over year versus 3.8% prior. Total revenue growth 5.3% versus 5.2% previously. EBITDA growth goes to 7.8% versus 7.4% previously. And similarly, free cash flow generation is now increased to 6.65 billion for the fiscal year 2020 versus 6.63 billion previously. So overall, all the metrics for this company are now going higher. I will tell you this, there's a few other things that you need to keep in mind. There's also potential M&A that is going to be coming in this space as well. First, note that Charter recently acquired for $464 million CBRS licenses to expand its coverage into 106 markets, with a focus on aligning better into the mostly densely populated cable areas such as Los Angeles and Dallas. This was only announced very recently, so they have expanded their footprint by doing a tuck-in acquisition into most dense populated markets, Dallas, LA, New York, and such. That's going to be positive for this company as well. And we don't know how much, if its broadband customer base can increase as a result. And last thing, there was an article that was out from Wall Street Journal. Let me pull that up real quick. There was actually in Routers, and this was on August 31st, which is right over here. And Routers discussed that TPG is exploring $8 billion sale for its U.S. cable operator called S-Town. Charter is seen as one of the bidders for this. Charter is one of the biggest ones, but there's also others that are involved in this bidding process called RCN or Grande Communications and Wave Broadband and such. So they're all opting to acquire this company. This was announced on August 31st. We have not heard since then. And so we'll see exactly if that piece also goes to Charter Communication. So lots of positive, but I think the key reason of liking for going into the next earnings report is this REO program that I discussed, which is called Remote Education Offer, which was relaunched on September 21st. That's it from me. Jay.
Morning, Vod. So last week on Wednesday, we had a client bring up GAP, GPS. Wanted to know what we thought of it, and so we decided to take a closer look, gather some research. So over the weekend, took a look at it, and first of all, let's just jump back to their Q2 numbers, which they reported at the end of August. So for those that do not know, Gap has a number of brands, of course, Gap, and then Old Navy, which makes up 57% of revenue, Banana Republic, and then sort of a relatively newer company called Athleta. So if we look back at the numbers from Q2, what did we find out? First of all, online sales were solid across the board, as you know, any retailer, while their store sales were lower across the board. Now, taking a look at some post-earnings commentary, RBC talked about how for Old Navy, traffic and sales momentum was aided by the fact that it has a 75% off-mall footprint, while also calling out strong customer trends as they reacted positively to product and marketing. The team also called out 24% category comps in both fleece and activewear. Turning to Gap, this was a strong performer, relatively speaking. Total comps were up 12%. Digital sales were up 75%. They also added that the fact that after many years of comp declines, you've started to see a nice positive rebound. And looking ahead, they have a Yeezy launch. So there's collaboration with Kanye West that's going to kick off in the first half of 2021. And then Athleta, previously they had reported this brand under the other category. Well, now that it's a sort of a standalone brand, they said the comps were up 19%, and overall net sales were up 6%. And an interesting analyst comment that actually came out prior to earnings was Citigroup upgrading it on August 25th, talking about how this brand, which is a women's activewear brand, may not be getting recognized by the market. This analyst believes that Athleta is worth $3.6 billion on a standalone basis, or in a potential sale if they ever decide to sell it off. Now, in terms of channel checks, we took a look at KeyBank as well as B of A. And the screenshot that I just shared, you'll see that with KeyBank's credit card transactions for the month of September, pretty much strong across the board for Old Navy, Gap, and Athleta. Now, Banana Republic, as you will see, is still lower, but it is trending in the right direction, if you want to put it that way. And then B of A, they were out on Friday with their own credit debit card data, where they talked about off-price, department stores, teen sales. But overall, they said that sales in the broader clothing category was up 9.1% in the latest week versus 4.6% in the prior week. They also said that the growth in the clothing category marks the highest since they started tracking weekly data back in February. And looking ahead for Gap, of course, you have your next earnings release in November, but more near term, you have an investor day taking place on October 22nd.
These are very, very strong numbers. And you know what's impressive about them? As recently as the week of September 20th, two of these numbers, Old Navy and Athleta, they were hitting triple digits growth.
Yeah.
That's just crazy. So this was all happening in the month of September, and that's telling you that Q3 earnings report is going to be absolutely phenomenal. Understand the Banana Republic remains the trouble spot, but as you mentioned yourself, on top of your head, what is that total piece of the total revenues?
Yeah, it's 9% for Banana Republic.
Right. Okay. So 10% roughly of your business is not doing well, but everything else is firing on all cylinders with high double-digit percentage growth, and as recently as just 2 weeks ago, hitting triple-digit percentage growth. And then here's the overall trend of the clothing retail based on Bank of America internal debit credit card checks. So this is very, very strong. And if you look at the chart, this is starting to break out. There was a power candle on Friday. It's going to start to clear all of this VOP congestion level. The first target, natural target on this one would be about $20 per share, which would be the upper end of this channel. So on a percentage basis, to go from 1835 where it closed on Friday to 20, we're still looking at about 9% move to the upside. MACD and RSI bull cross is also coming right now. So very nice technical view, very nice fundamental view, and we have seen pickup in option activity in this one as well. So thanks for taking the question from the client in the chat room and following up with this, Jay. Good stuff. Jay, Chronicle.
Morning, Fahad. Looking at the exchanges, I like either ICE or CBOE going into year end. ICE has the better looking chart. Both cases pretty straightforward. Both of these exchanges are currently approaching very easy volume comparisons for Q4, while we're going into a period of uncertainty with elections coming up as well as Brexit. So I think ICE can beat the 5.5% growth that we saw last year. And also, if we factor in the oil and commodities volatility that we're seeing currently, that's another tailwind that we didn't have last year. Meanwhile, CBOE is going to be the one to benefit the most from options activity. So I like those two. Notice I didn't mention CME. I'm avoiding CME for a couple of reasons. First off, there's not enough interest in the rate markets these days. Whatever happens going into the year end, central banks are going to continue to do their best to suppress rate volatility. I think the only way we get any sort of rate volatility is if we get some sort of out of the blue black swan that even the central banks didn't account for. And even then, they're just going to intervene almost right away anyway. So betting on rate volatility these days is sort of a losing game. And this is important because roughly half of CME's volume comes from the rates and treasury markets. And so low volatility has negative implications for their revenues from spreads, commissions, overnight fees, which themselves can be tied to rates. So it's sort of like a domino effect. So I think ICE and CBOE are better off in the sense that commodities and futures and options are going to see better volumes and better volatility compared to the rates markets. Most recently for August, ICE reported a 9.5% sequential increase in daily average contract volume, and CBOE reported a 7% increase. But CME reported a decrease with interest rate contracts down 48% year over year, which is pathetic. So that's my first point. The other thing is, of course, the ongoing DOJ investigation into exchange data feed pricing of those companies. That's been going on since June, like basically the price of the information that's being sold to financial institutions and HFT firms. Those investigation headlines have been popping up again in recent days. Nothing new from what I've seen. And out of the three big exchanges, CME is the one with the highest revenue exposure to data services. So that's the other reason I don't like CME. Now, you can make the argument that ICE derives 40% of revenue from data, but what I would say to that is the company is continuing to make efforts into diversifying into other streams. For example, they recently acquired Ellie Mae, which has a huge moat in the residential mortgage business. As we all know, it's currently a good time for housing. Separately, they're also getting into the digital asset business and retail asset management, and those are just several examples. So to conclude, I like ICE the most going into elections, and the chart looks great. I also like CBOE, but I'm avoiding CME.
Great stuff, and I agree that chart-wise that ICE has one of the best looking charts than the other two, CBOE or CME. So that alone plays into the advantage for purely technical standpoint. MACD and RSI bull crosses here as well. I would set an alert around 102. If it starts to take out 102 on decent volume, that would be the trigger. And then I think we can easily see for a run back up to new 52-week high. That's purely technically speaking. I have seen a little bit of a pickup in volatility in the Forex market recently. And I think this has started to happen after we learned that Donald Trump on Thursday night has contracted COVID-19. So the US dollar started to get a little bit higher volatility as a result. And so we'll see. The news is still fresh. It may not be anything, but I would expect slightly higher volatility in the Forex land. Also, generally going into the election cycle, I think that equity market is the one that's going to see more volatility than the bond market. And I agree with you about the bond market. There's just not much volatility there right now because everybody knows where the Fed stands with the interest rates already at zero, QE and QE full blown in play. There's really not much there right now to see. TLT has not done much in quite some time. So it's Forex and it's equities and maybe a little bit in commodities. So those would be the areas of focus. Great stuff as usual. Thank you very much, for all of this. We'll see you in the chat room shortly.